Right, lecture 7, foreign currency. So what we're going to be looking at is foreign currency, but more specifically, it's not foreign currency in itself which is the problem. If foreign currency was there, but was fixed in terms of the exchange rates, this wouldn't be a topic at all. We just have to use a calculator, multiply something by a certain ratio, and bang, we could just add everything up. Why it is an issue is because these things change. If they didn't change, it wouldn't be an issue. It's the fact that foreign currency exchange rates fluctuate, which is a problem. We're going to be looking at regulation, and that is specifically AASB 121, the effects of changes in foreign exchange rates. We're going to be looking at two aspects to that. We're going to look at foreign currency transactions. So that's transacting in a foreign currency, strangely enough. And we're going to be looking at foreign currency translations. And this ties into if you've got a subsidiary based overseas, presenting in a different currency and rolling that into your presentation currency so you can basically do the consolidation. Now, I'd imagine looking around the room that either you may be from somewhere other than Australia or that you may travel. You know, most of us have probably been on a plane at some point in time. We've had to use a foreign currency at some point in time. So we understand that these sort of things, well, trade is growing, globalization is occurring, and this is a big factor in why this is becoming increasingly an issue. Some stats from the World Trade Organization, a couple of years ago, global merchandise exports were close to $19 trillion. So we're talking substantial amounts of money here. Service exports were close to $4.5–5 trillion. Those are not insignificant amounts. And that even glosses over any sort of capital flows across borders. So I mean, we're talking some serious money that's going on here. And this is a graph, that's 2000, so let's say that's about 1995, thereabouts. So this is the last 20 years or so of the Aussie dollar, US dollar exchange rates. We're now down under 80. Go back a couple of years, we're up well above parity. You see here there was a big drop that happened in July, August 2008. These things are volatile, these things move around. And so it does happen. One thing that's, to give you, the Aussie US dollar, I mean, yeah, it's annoying, and especially if you want to go to the US, but this is on the front page of the Australian yesterday. I don't know, ever since they made a World Cup final, they've been getting all uppity with things. But if anyone's a Kiwi in the room, so be it. As our dollar slides, they're ready for a parity party across the ditch. We're nearly at parity with the New Zealand dollar. If anything, we could go under the value of the New Zealand dollar, which, I don't know, as an Australian, I find that kind of troubling. But things move around. You go back a few years ago and we were buying well above $1 New Zealand dollar. Sounds strange to talk about. So this is something which is happening, and we're going to see it occur. Especially with iron ore prices doing what they're doing, iron ore prices and the Aussie dollar are quite linked, or it seemed to be quite linked. So we could well see some movements because of that. So the question to set up to you guys, we know foreign currency exchange rates change. That's a given. So imagine a situation where you borrow 5 million US from an international bank. So you actually are borrowing $5 million US. And at the point in time in which you borrowed it, exchange rates are at parity. So 1 Aussie buys 1 US. The rate now is 1 Aussie buys 77. So the Aussie dollar has slid substantially against the US dollar over that period of time. The question then comes down to how do you feel that you account for that? And I'm not necessarily asking for an answer right now because we're going to explore how we do this. But just on face value, this would generally be how we'd pick up the initial transaction. We've borrowed $5 million US, and let's say we haven't done anything with it. We just got it in and we've just got it sitting, like obviously in reality you're not going to have it sitting there with a pile of cash on the floor, but let's imagine we've got a pile of cash on the floor of US dollars. We've got cash in and we've now got this foreign currency loan. This is at the point of time in which the transaction occurred. What happens 6 months, 12 months down the track when the exchange rates have weakened from an Aussie point of view and we get to the financial year end? Do we leave the cash at 5 million? Do we leave the loan at 5 million? Do we adjust them? If we do adjust them, how do we pick up that adjustment? Are we taking it through to surpluses? Are we taking it through to profit? What do we do? And so that's basically what we're trying to get at here. Does it depend on the type of thing that you're dealing with? Does dealing with a foreign currency monetary thing like cash, does dealing with a loan or a payable? What about if you've got foreign property which is denominated in a foreign currency? How do you deal with that? What happens if that thing is dealt with on a revaluation basis? It starts to sort of have a few moving parts in there. But I think after having had a quick look at that, and I already saw a few people kind of nodding and shaking their heads at various points, I think everyone would be pretty comfortable with this idea that we wouldn't leave it like that. I think everyone's relatively comfortable that if the exchange rates move, that wouldn't be left as is. And if that's what you were thinking, well, you're on the money there. The question there is how do we do it, which is what we're going to have a look at. So AASB 121, the effects of changes in foreign exchange rates. So there are three types of currencies that we've got to deal with, and we're not talking about yen or pounds or dollars or anything. Definitions of types of currencies. So the first is the functional currency. And the functional currency is the currency of the primary economic environment in which the entity operates. For the most part, that will be generally straightforward. If you're Woolworths, for example, Woolworths is quite a big company, is mainly set up in Australia but has a division over in New Zealand as well. I would pretty much say that Woolworths' primary economic environment is Australian dollars. That's pretty much where most of what it does happens. But what happens if you're an airline like Qantas? Like, it travels all around the world. How do you figure out what its primary economic environment is? What about mining companies like BHP? It mines all over the world, and what it sells, commodities, is mainly priced in US dollars. So what's its primary economic environment? It's just something to be aware of, that that's not always a cut and dried situation. The presentation currency is, as what you'd expect, the currency in which the financial statements are presented. Accountants, if from time to time, are fairly logical with how they set things up. So when you open a set of financial statements, the currency that it's in, that's presentation currency. Those, I think we're making an assumption, I'm pretty sure we make the assumption that for what we're doing, the functional and the presentation currency are going to be the same. Now, most companies that are listed on the ASX have a Aussie dollar presentation currency, but not all. There are companies out there which have a different currency. It might be the US dollars, it might be Singapore dollars. So it's not always Aussie. And last but not least, foreign currency. And that is just something other than the functional currency. So if you're an Aussie-based company and with Aussie functional, pounds, yen, US dollars, something else. So now that we've got those sort of ideas set up, the two things that we're going to be looking at today. I'll preface this up front. Foreign currency translations is much easier to deal with foreign currency transactions. When we get to it, you'll see why. So foreign currency transactions are if you're buying and selling something in a foreign currency. So if you're Aussie-based and you're buying supplies from overseas, if you're borrowing money from overseas, lending to overseas, those are all going to be foreign currency transactions. Foreign currency translations are, and this ties in, if you're doing ABC at the moment, which I know a few of you guys are, you're already starting, you did NCI last week? Yep. It's a fun topic. But you've already seen how, like, the process that you need to go through, and it's quite a convoluted process to come up with, to get everything from a subsidiary and consolidated into your consolidated accounts. Then start to think of all these additional issues which start to crop up. If that subsidiary is based in a currency which is different than your presentation currency, you've got to make adjustments, because you can't have something which is denominated in Japanese yen and just add those into Aussie dollars. Like, you've got to translate them first. If those subsidiaries use something other than Australian accounting standards or international accounting standards, you've got to adjust the accounting before you do. You've got to adjust the accounting, and you've got to adjust the currency before you bring them in. Then you throw into the mix that some of these big corporate groups have hundreds of subsidiaries, and you're having to do that with all of them. Like, it's not a small thing to do. So we're going to have a look at how that does. So this, again, ties into what you see happen in ABC. So the first thing I want to talk about is foreign currency transactions. As an aside, whenever I see this, because I obviously use this picture each time I do this lecture, when we were coming back from London, we had some stuff shipped back home. And I just had, until it actually turned up at until it actually turned up at home, I just had basically, not every night, but sort of dreams of our stuff in one of these containers and the ship kind of listing and just containers falling into the ocean and just thinking our stuff's falling down there. It didn't happen, but it took a long time to get home. These are sort of things, you're buying stuff from overseas, you're selling stuff to overseas that we're dealing with. So when that particular event happens, so if we're talking about the loan that happened initially, sorry, what's your name?
James.
James. So James is based over in the UK, and I borrow money from, he's a bank, and I borrow money from him. The point in time which that transaction happens and I borrow money from him, that is the date of the transaction. So what we're interested in is, what is the exchange rate? What is the spot exchange rate? So the definition comes up in a second. Is the exchange rate for immediate delivery. So what is the rate of the Aussie dollar pound, what is the Aussie dollar Great British pound rate at the date in which that loan actually occurs? So that's the spot rate, and we record it in the functional currency, so if in Aussie, by applying the foreign currency amount to the spot exchange rate between the functional and the foreign currency at that date of transaction. So that's not that controversial. It's fairly easy to make happen as well. So I borrowed, let's say, £1 million from James, and I'm going to reflect that I have a certain amount in Aussie, and the dollar's buying about 50p at the moment. So I've got about 2 million, the equivalent of about 2 million Aussie now. But if that Great British pound Aussie dollar changes, we're going to have changes that occur up here. Because at the end of the period, if we have a monetary item, we need to pick up that change. And so in essence, I borrowed money at a certain point in time from James. We walk through to the end of the financial year, whenever that happens to be, and whatever the exchange rate is at that point in time, if it's a monetary item, and things like loans, accounts payable, accounts receivable, even cash, foreign currency denominated cash, those are monetary items. And so we just look at what the value of those things are at that financial year end, and that's what we need to change it to. Which means we're already now picking up there is a change that we need to apply to it, and we've got to figure out where that change goes. Non-monetary items. So if we've purchased property somewhere, and that property is denominated in foreign currency. If it's historical cost, so it might be using the cost model. If it's property, plant, and equipment, you use the rate at the date of the transaction. If it's done at fair value, so it might be investment property, which we don't look at, but investment property under IAS 40, AASB 140, or property, plant, and equipment under the revaluation model, taking it up to fair values. If you're doing fair values, you figure out the fair value and the date that happened, and it's the date, the exchange rate at the date in which you got the fair value. That's the number that you use. So we do make adjustments for these things, is the long and the short of it. Foreign currency definitions, monetary items. Kind of talked about this already, but units of currency held in assets and liabilities to be received or paid in a fixed or determinable number of units. So accounts payable, loans payable, accounts receivable, cash, that sort of stuff. Closing rate, again, fairly logical, is just the rate at the end of the reporting period. Okay, so we've got this loan from James, and it's changed. Any change that happens, see if I can. Okay, any change which happens goes into profit or loss. So if Aussie dollar actually we won't get confused about if a loan or a payable goes up or down, what it does. But if there's been a change, if that means that I'm crediting a liability, that debit will be some sort of loss. If I'm doing something with a liability and I'm debiting the liability, I will credit something and that credit will be a gain. So I'm just picking up whatever the thing is in terms of profit or loss. Where it gets into something slightly different is if you're dealing with non-monetary items. So when a gain or a loss on a non-monetary item is recognized in OCI, any exchange component. So the thing is, what you do with it underlying, or what you would normally do with it, that's what you do with it from a foreign currency point of view. So if you've had a revaluation that's taken place, in essence, because an upwards revaluation that's taken place, in essence, because it's a foreign currency change, that would go into OCI as well. It's not a gain or a loss. Normally you take it through to OCI. In this case, you take it through to OCI. If normally how you deal with that non-monetary item is profit or loss, so an impairment loss, it could be a revaluation loss, you pick it up in profit or loss as well. So what you do with it in a normal setting without foreign currency movements is what you'd actually do with it with foreign currency movement. So it tracks through in much the same way. Okay, so moving into the examples, what we have here is, I'll make a couple of points with this as we move through. And actually this relates to not just what we're going to do here, it relates to what you need to do for assess exams as well. See if I can put that there. And that is, timelines are going to be massively important for you. It just helps you visualize when things take place. Now, it may seem a little bit straightforward to do it with this, but if you do it with this, that's one thing to deal with. But what we're going to see is when we come back in a few weeks' time, we'll be getting similar sort of situations and then layering in hedge positions over the top of them. And then you need to be looking at what's going on in the underlying position, which is what we're looking at today, and then what's looking at the derivative position, which is what we'll be looking at in a few weeks. Having that, for me anyway, having that mapped out just makes it much easier to see when things take place. So again, you don't have to, but I would urge you to think about it. So we've got Poor Trading Co. agrees to purchase air conditioning machines with a value of 100,000 US from Cool Air Manufacturing on the 12th of June 2013. The air conditioners are shipped and title passes on the 16th of June 2013. Poor finally pays on the 15th of July, and we've got a whole range of exchange rates, which you guys have on your sheet. So it starts at 106. The US weakens slightly to 104, then it strengthens to 109 and strengthens to 110. Apologies, I thought I'd discard that. All right. Where are we? Okay. So not quite to scale, but okay, so what we have here is the order date. We have the purchase date. We have the financial year end, and we have the payment date. Now for us, what we're interested in this case from an accounting point of view is when this company would actually record the inventory coming on their books, because that's the point in which you would have a transaction. So the 12th of June, the order gets put in, but they haven't taken delivery of the goods yet, and title hasn't passed, so you wouldn't actually do anything. So we're not worried about anything taking place here. At the purchase date, this is where we have something occurring. So we debit inventory, and we credit account payable. Now, what we're interested in is, remember the spot rate, we're using the spot exchange rate to figure out how much we put down here. Now, the exchange rate at this point in time was 1044. So $1 US equals 1044 Australian. We had US dollars 100,000. So the AUD equivalent of that is just this by this. So what we end up with is an AUD equivalent. So the initial recognition is the spot rate applied to that foreign currency amount, which is 104,440. And we pick up we pick up 104, it doesn't quite look correct. Sneaky 4 missing in here. So 104,440 debit inventory, credit accounts payable. Now, what we're interested with in these two accounts is the accounts payable, because the accounts payable is the monetary foreign currency amount. The inventory is not a foreign currency amount. It's not a non-current. It's just you purchase inventory. It happens to be valued at this. We don't touch the inventory account after this from a foreign currency perspective. It's the account payable, which is the thing that we're interested in. Because at the end of the financial year, that is going to change in value if the foreign currency rates do. And they do happen to change. So at the end of the year, we're looking at the closing rate to deal with the account payable. And I'll screen and change the ink color. And the exchange rate at this point in time is 109.34. It's gone up by so again, what we're picking up is two things that we're doing. Firstly, at the end of the financial year, you've got to figure out what the rate, what the amount of that foreign currency payable is. And you use the closing rate, which is the 109. We still owe the same amount of US dollars. Now, a good way to think about it is, it's almost like we just owe an asset. It happens to be cash, but we just owe this thing to someone. And what we're doing is just changing, figuring out what the value of this thing happens to be. And so that 109,340 is what the value is now. That is how much has to be on the books. So you can already see from 104,440, it's gone up by 4,900. So the liability itself has to be credited by 4,900 to pick up that difference. So we credit accounts payable 4,900. I'm going to unfortunately run out of room at this end. We need to debit something, and we need to debit something 4,900. And if you remember back to monetary items, what we debit or credit them is going through to profit or loss. So in this case, the accounts payable has gone up. We actually have to physically pay out more money to pay for this. That's obviously not a good thing. You can call it a foreign currency loss, I don't know, something along that spectrum. We have a foreign currency loss of 4,900 and an increase in the payable. When it comes to the payment date, we do exactly the same thing, and then we have to figure out how much we actually pay out in cash. So it's the same process once more. And what's a good pen color? Let's try this one. So the rate at the final point in time, it's got even worse. 101,045. We've still got the 100,000 US. The AUD becomes 110,450. And this has gone up again because the Aussie dollar has weakened once again and we owe money. And now we owe an extra $1,110, which is obviously not a good thing because that's more money that we have to pay. So we build that in and we would have the same set of entries And where I'm going to do it, I'll do them right at the bottom. Sort of. So this is for this point in time. We would debit loss 1110, and we would credit accounts payable 1110. So that's picking up the change, the profit or loss that's taken place. And then to finish things off, we just need to pay it out. So we debit accounts payable. And what do we have? 110450. And credit cash 110450. So initial recognition at the spot rate. We move along, we pick up the closing rate, and then when we finish it all up, we pick out whatever the rate is at the date in which you finally pay it all out. What you can see, and this will start to sort of bring in what we're going to be looking at in a couple of weeks' time, is that there is risk involved when you're dealing with foreign currency payables, because there is a foreign currency exchange rate risk. Foreign currency rates change, you may find yourselves on a hook for a lot more money than what you initially thought. Now, if you think back to the graph right at the start, I was in the US as this was happening. When I was there, start of August 2008, I was still getting stuff on my credit card coming through at about 88, 89 cents. Like one Aussie was buying 88, 89 cents US. 2 weeks after I got home, it was buying about 60. Like it dropped massively and very, very quickly. If you borrowed $1 million US at 88, 89, had to pay it back in 2 weeks' time, you're paying like $1.5 million. Like that's a substantial change across 2 weeks on a foreign currency movement. You just have to see what happened when, like in January, when the Swiss changed the way that they were pegging their currency and the Swiss franc appreciated like 15% overnight. Some of these things happen, you know, everyone was pretty, you know, nodding head, everyone was kind of unhappy about it when it took place. And quite a lot of CFD brokers, I think, went bust because it caused some problems, suffice to say. So what we're going to start looking at in a couple of weeks' time is how we deal with the risk involved in these things and the types of instruments that deal with it and the accounting for those instruments. So it's just sort of foray into it. We've got to do this one first and then we're going to have a look at that. Okay, so the second one we want to have a look at is, do you want to do, I'll do this one first. Okay, so Waratah Airlines Limited. An Australian airline has terminal facilities in New Zealand for handling freight. Now I would say if you did this about 4 or 5 years ago, you could talk about the fact that they needed to handle freight for all the Kiwis immigrating over here. Talk about it now, it's actually going the other way in Australia. People are leaving here to go to New Zealand. Such is life, I suppose. Although we won't let in Russell Crowe, if anyone saw that. We won't, they knocked back his citizenship recently. I think it's his second or third time applying. Well, what can you do? This includes land which is purchased on the 1st of July 2011 for New Zealand $5 million. Waratah Airlines Limited adopts the revaluation model for accounting for the land, and on the 30th of June 2013, a revaluation is undertaken, and the land is found to have a fair value of New Zealand 6 million. But over that period of time, so that's a 2-year period, the time in which the land was purchased was at 1.18. The New Zealand dollar has weakened over that period of time. I'm pretty sure I used real rates, so you can see how much it's improved in, what's that, close to 2 years since this has been done. At this point in time, there's no revaluation done. At 30th of June 2012, the revaluation doesn't happen at that point. The revaluation to the land happens at 2013. But at 2012, the foreign currency rates change. So that will have an effect, and that's what we need to have a look at how we deal with that. So I think I need to, give me 2 seconds. There you go. Okay, so what do we have here? So I'm just trying to keep some element of surprise. Where are we? options. Purchase, reval. And there's just a year end in here. So this is for start of the year, this is start of the second year, and this is the end of the second year. At this point in time, the foreign currency rate was 1 Aussie buys 1.1803. This is 1.2756, and this is 1.2941. But what we're dealing with is the purchase price was 5 mil. At this point in time, there's no revaluation takes place. So from a New Zealand dollar perspective, what we're still dealing with is 5 million. But the revaluation at this point in time means that the New Zealand dollar that we're dealing with, or the value of the property from a New Zealand dollar perspective is 6. And you can already, if you're thinking about it, you can already start to see what's going to happen in that after that first year. Because if we're an Aussie presenting company with an Aussie functional price currency, and the Aussie dollar has strengthened against the Kiwi dollar, and we're valuing this Kiwi dollar property, the value of that is going to drop from an Aussie perspective. And that's going to have an impact that we need to deal with. So for the initial transaction, we debit land and we credit cash. And it's 1.18. If you've got this, if you printed out the information that you have here in the Word document, the numbers are all correct, but there is actually an error in each of the calculations, which is, if you look just under where the entry takes place, I've done it as 5 million times 1.18. I've done it as 5 million times 1.276. Those multiplications should actually be divided in each time. You can see how 5 times 1.18 certainly doesn't give you 4.23. I mean, you don't need a calculator to work that one out. But the 4.23 is actually the right number. I've just got a sneaky little typo in there. And that's not to make sure that people turn up to lectures. 4236 to 11. 4236 to 11. So that's the 5 million divided by this. So it's 5 divided by 1.1803. Change the color up. Okay, but what happens here is, at the end of this year, the foreign currency rates have moved. And they've moved in such a way that it's going to mean the land is actually worth less. So even though we don't have a revaluation, it looks like the land from an Aussie perspective is impaired. And that's what we're actually going to do. So even this is actually combining revals and impairments, which I know we didn't do previously, but we'll see how this works in this context. So first up, let's get whatever the value of this happens to be. And so 5 million divided by 12756 gives you, what does it give you? 3919724. So what I might do is I'll put this under here. So we've got 4236 to 11. Okay. So we've gone from a value of 4.236 down to a value of 3.3919. That would look like the asset's impaired. It's been carried too much on the Australian books for what it's worth from an Australian perspective. So we would have an impairment loss at this point. So we would debit impairment loss, and it's just picking up whatever that difference happens to be. So from 4236 to 11 to 3919 is a drop down of 316487. And so we have debit impairment loss, credit accumulated impairment of 316487. Okay. So we've picked up the fact that this asset is impaired. Now the last thing which happens is we have the revaluation take place. Now to do that, to come up with the Australian value of it at this financial year end, and we're assuming the revaluation takes place on the 30th of June, so we're doing it at that point in time. We then look at what the value of this is, and the value of 6 million divided by 1.2941 gives you 4636427. It's gone up, and it's gone up to the tune of 716. Okay, so the key point just to take with all of this is what we're doing at the end of each period of time is just looking at, from an Aussie dollar perspective, that is being shown there. So we're going, it's worth 4.236, it's worth 3919, it's worth 4636. So that's what's getting reflected in terms of the values on the books. The first case, we're having a drop down, it's an impairment loss. The way it gets treated is just the way that it would get treated normally. And that's what we saw from the earlier slides. When it comes to the revaluation going upwards, we're actually going to treat it how we normally deal with it. So the first thing that happens is we get rid of the impairment loss. So the impairment loss which did take place, we actually just completely reverse that out. I think this was a reasonable color. Oh, where is he? Sneaking away. Impairment loss reversal, and I've run out of room there, but it's 316487 for those two. So debit accumulated impairment, credit impairment loss, and it's just literally reversing out what we saw there. And then we're picking up the revaluation, and that would just get picked up through debit land, credit, I'll just call it surplus instead. And if I can fit it in, it is just whatever you need to make up the difference of the 716. So it's the additional over and above this amount to get from 3919 up to 4636, which in this case is 400,216. Draw it in really. I need to get my writing neater. So we've recognised it up front, just using the spot rate. We've looked at the date in which the impairment took place, which we're assuming is the end of the year. If the impairment took place at a different date, we look at the rate at that point in time. We then come to the revaluation taking place. We're assuming the revaluations happen on the 30th of June. That's picking up the value of that. We then reverse out the impairment that we had previously, and we pick up the land and the surplus which is taking place. Now, if this had gone the other way, and this was above, it wouldn't be an impairment loss. You wouldn't actually do anything with it. So this isn't a revaluation. This is just a change which is taking place because of the exchange rate movements. If it had gone, so the value of the land had actually improved above what was initially being carried, that's going above what the original cost was. That's not, and it's not the revaluation which is taking place at that point, so you wouldn't deal with it in that respect. So which is getting through all of that stuff. I'll give that a moment. I'm doing good for time. All right. Done that. So, what I want to talk to you guys about today was, last week I mentioned I don't get out to see movies as often as I'd probably like to, although I find that last time I went to actually when I was in London, went to see a movie on my own, and I found I was it's like getting sort of twitchy and wanted to check my phone after about half an hour in. It was like, whether it's a movie, whether it was just, that's unfortunately what happens with this nowadays with phones sort of everywhere. But I mentioned last week that Shaun the Sheep was opening up. It opened up last Thursday, so I duly, over the last few days, went off and took Evie along to see Shaun the Sheep, and it's actually quite an enjoyable movie. I'm not talking about Shaun the Sheep, but what I am talking about is a really horrendous segue into Hollywood accounting, because it is actually a thing. For any of you, and I know there's a few phones in the audience, people are already starting to get twitchy. I see they've been getting twitchy for a while. But if you do at some point want to Google Hollywood accounting, it is a thing. There's papers written on it, there's stuff about it. So the question is, what is Hollywood accounting and why are we actually too fussed with it? Now, what it actually is, it's quite an interesting thing. It's not company specific. So we're not looking at, company X did this, that, and the other. What it is a fairly general industry practice which takes place. And it seems to be fairly pervasive in that particular industry. So what is it? Now, before we get into what it is a good thing to understand is the way a lot of contracts get set up in these situations. Now, how many of you guys have seen Gravity? Who was Sandra Bullock? Now, from what I read, she grossed something in the order, bless you, of something like $50 million from that film. Anyone seen The Avengers? Or any of the Iron Man movies? Okay. The Avengers, what I heard, was like one of the biggest grossing movies of all time, which, I saw it on a plane. Maybe I didn't see it on a big enough screen. It was all right. Robert Downey Jr. makes an absolute mint from those things because he doesn't just get paid a flat fee. And so this is where this is going. What he does is he gets a percentage of box office receipts. So he gets a percentage of gross. Now for that, there's not much companies can do or the studios can do to affect what that does, because that's getting brought in, they see that, you can't really do much with that. And it's only like the super big movie stars that can get contracts written in gross, because they know what happens if contracts get written in net. And net is basically the net profitability of productions, net profitability of TV series, and so on. And that's where this is going. And you're already starting, I hope everyone's starting to figure out what they think is going to happen. So what happens is it's to do with the payments that take place. Now, most of the people involved in the movie industry are just getting paid bog standard wages. So they're not going to worry about if the movie does well, if the movie does badly, they just get paid whatever. Some people get paid gross, some people get paid net. We see lots of examples where really popular, really supposedly well, good box office receipts type programs suddenly don't do that well. And we're going to talk about how that takes place. So Forrest Gump being one. Harry Potter, now this is probably more down your era than my era, but Harry Potter and the Order of the Phoenix. How many, was Harry Potter books came out sort of early 2000? That's actually getting quite, God, that's getting quite back time. So that was about 2000. I actually remember someone reading one of them when we were at work in 2000. So how many, you guys, some of you would have read Harry Potter. Yeah, a few people. So, I don't even know, there were what, 7 or 8 of them? Actually, didn't they split the last movie into 2? Yeah. They did. Bloody. That was the thing. I thought The Hobbit was going to be one, I know it's not Harry Potter, I thought The Hobbit was going to be one movie. Saw it on the plane and was like, cool, I'll watch it and finish it off, and they barely left anywhere. It's like, they really split that into 3 movies. Tight asses. So let's have a look at what's happened with some of these. So Forrest Gump. It grossed a fair bit of money, 677 million. The story this is based on was sold to the studios for $350,000 plus 3% of net profits. It didn't make money. Forrest Gump didn't make money, which is surprising. But for those of you who are Harry Potter fans, this may be even more surprising. Harry Potter and the Order of the Phoenix grossed nearly $1 billion and lost money. If you're going to make something which makes nearly $1 billion and lose money, you're probably not in the right industry. So they set things up to lose money. They're not actually losing money. So that's kind of the point that's been made here. But they set it up to make it look like they lose money. This is probably one of, well, it's just finished. I mean, season 5 is just finished as of last Monday, I think it was. Show that I've been watching, obviously, since season 1. Frank Darabont, who created The Walking Dead, is no longer associated with, even though his name's sort of all over it and you're created by Frank Darabont, I think he was either fired, he definitely left after season 1. Now he is suing AMC because his contract was written, now this is all allegedly, so I don't know who's at fault here or whether or not it's necessarily 100% true. But what he is alleging is that even though this series actually makes a fair bit of money, they are claiming it loses money because he is getting paid net profits based on what AMC, the production side, makes. Now this is where it's almost transfer pricing some of what's going on here. So you've got AMC, the production arm, but then you've got AMC, the distribution side of things. His contract is with AMC, the production company. So if they're making money or making profits, some of that profits will accrue to him. If these guys make money, he doesn't get any from that. So what's basically happened is they're selling it to these guys for either a very small amount or they're loading up the expenses down here. This is where it's being sold, the rights are being sold off elsewhere. These guys are making a mint. This group isn't making anything. And that's where his contract is, and that's where his contract is. So they're setting these things up so they look like they're losing money. It's a contractual relationship. And you'd think, again, there'd be reasons for companies to want to make profits. But depending on who owns what and who owns it where, arguably there are reasons for companies to lose money. You may have seen what happened yesterday. If some of you, if you've been reading the press, you'll certainly know what's going on. But yesterday there was a Senate committee, the Senate Standing Committee on Economics had the first public hearing on tax avoidance. They had Google turn up, they had Microsoft turn up, they had Apple turn up. You may have read in the paper, and I think that was about News Corp. There was something else in the papers on the weekend about BHP and Rio and the way in which they basically make no money in Australia, or allegedly make no money in Australia, and then sell it through to their Singaporean arm at a really low price, and then that Singaporean arm sends it up to China, and that's where the markup occurs. Reason being, Australia has a 30% tax rate, Singapore has a 2.5% tax rate for these companies. Where do you think you'd want to make money? And it's not in Australia. So it's not just about, I know that's sort of segueing into something completely different, but the same sort of idea holds, is that if you can make things happen in certain ways, there are reasons why you'd want to do it. Cool. So foreign currency translations. If you've got the standard, from a practical point of view, if you've got the standard with you in an exam, there's only really two things that can go wrong with this sort of, from a work-through perspective with this. But we'll have a look at what we have to do. So foreign currency translations. The rate used, so this is where you've got a financial statement, or financial statements in foreign currency. It could be yen, could be pounds, could be Hong Kong. What does Hong Kong use? Never been to Hong Kong. Hong Kong dollar. I thought it was Hong Kong dollars, so that didn't feel right. Hong Kong dollars. You've got something in a foreign currency, and you can't just add that into your, if you're an Australian presenting company, you can't just add Hong Kong dollars into Aussie dollars. It's going to make everything look funny. So you need to translate it. And what you use depends on the account type. Assets or liabilities, you just use whatever the closing rate is. And that makes a lot of sense, because think about what a balance sheet is. It's a snapshot. So you get to that financial year end, whatever is on the balance sheet, you just go, well, this is the rate things should be translated at. Just multiply everything or divide everything or do what you need to do, adjust it. That's relatively straightforward. Income and expenses, you use the rate on the date of the transaction. How reasonable does that seem? In some senses. Now, I'll put it this way. Woolies in some ways a bad example because it's mainly an Australian business, but Woolworths sell, in terms of their revenues, Woolworths sell over $1 billion worth of stuff every week. How easy is it going to be for companies, multinational companies, to work out what the exchange rate is on every single thing that runs through their revenue expense on the day in which it occurs? Probably going to be pretty tough. So what they allow you to do, and it's not up here, but it is within the standard, is that they say you can use the average rate if that makes more sense and if that's easy to do, because that would seem a lot more intuitive. Now, if you think about the average rate, for most companies, depending on their business cycle and what they're really doing, an average rate for the entire year could be quite reasonable. So if Woolies sells about the similar sort of level of stuff over its year, use the average rate for the entire year. But you could have seasonal type situations where certain businesses are a lot more active in certain times of the year. So you may want to use the average for those points in time. And the thing that I'm thinking of, especially now that winter is coming, is ski resorts. Ski resorts don't run as ski resorts 12 months of the year. They might run, certainly, Threadbow and Perisher run as something else during the rest of the year, but I don't think the majority of their money comes from the summer months. I would hazard most of the majority of the money comes from the winter months. Vail, or the organisation that runs Vail over in the US, have just bought Perisher. So if they were having to do something with Perisher, they wouldn't be using, I'd say, the average rate for the entire year. They'd probably be using the average rate for the ski season, which, given the way the weather seems to be going, could be shrinking and shrinking and shrinking. But that's the sort of thing that you'd use. But something's missing. Thinking about the elements that we have, what's not up there? There are 5 main accounting elements. The exam's in 5 days' time. And I know this isn't in there, but come on, you guys are accountants. What's missing? Equity is missing. Why does that not bother us? I would hazard why it doesn't bother us, because of the good old accounting equation. Assets have to be closing. Liabilities have to be closing. That means equity as a total equity, maybe not within the line items within equity, but equity as a total has to only be one thing. It has to add up, be a number which adds up to assets, for assets equaling liabilities plus equity. It can't be anything different. So if you imagine, I picked a wrong place to do that. If you imagine you had 100 equals 70, equity has to equal 30. It can't be anything other than that. But the way in which the constituent parts of equity come about may mean that you don't actually have it on the initial run adding up to 30. So you may have a situation like this where you've got 100 equals 70 and you've all done it through and you have 25. And this is the bit people commonly screw up when they come to these sort of questions. This doesn't balance out. Any exchange differences are recognized in a separate equity account. We just add 5 to this side. That's all that we're doing. This, the foreign currency translation reserve, is whatever number that you need to put into equity to make that equation work. It's nothing more and nothing less than that. So if once we've added it all up and we've got 95 on one side and 100 on the other, we've got to throw 5 in to make it all work out. That's your foreign currency translation reserve. If we have 110 on one side and 100 on this side, we take away 10 to make it all work. Foreign currency translation reserve can be negative, it can be positive. It is just simply whatever you need to make it all add up. Different context, but think about what goodwill is. Goodwill is just simply the amount that you need to put in to make the transaction all balance, because you've paid more for the company than what the company's assets are worth, net assets are worth. The FCTR is literally what you're putting in to make sure the balance sheet balances after doing all of the various adjustments that you need to make. So that's what we're just going to have a quick look at how to do. Okay. So on the 1st of July 2012, Bill Limited, an Australian company, acquires all the issued shares in TED Limited. Can't tell what I watched growing up. A company incorporated in the US. Exchange rates for the year ending 30th of June 2013 are as follows. We've got the starting, we've got the start, we've got the end, we've got the average rate per year, and we've got the ending inventory acquired point. Now, you may not necessarily in an exam or a question you have get all of these. You may get some of them. You may get more things. It just depends on what is relevant for the types of questions that you're asking. Point of note, though, that ending inventory acquired is not used in the balance sheet. It is used in the profit and loss statement. Okay. So you guys have got the numbers sitting there. I hope you do. I've got the numbers sitting somewhere else. There. Okay. So we'll just run through the types of, if you would get something like this in a question, everything on the left-hand side is what you get given. The 2 columns on the right-hand side is what you wouldn't be given. And literally what you'd need to do is just to figure out what rate to use and then make sure you divide or multiply it the right way around. And that's actually the first area where people have problems. Do you get a rate and then do you multiply it, or do you get a rate and you divide it? Now, the way in which we'll quote foreign currencies will be like this. So 1 US equals something, or 1 Aussie equals something, and 1 Japanese yen equals something. So it's relatively clear, I hope, that 1 US buys you 9.7. So in that case, the Aussie is strong. In the first instance, the Aussie is stronger than the US. The ones which I really struggle to understand how they do it. I think you see stuff like AUD, USD, and I really, maybe I'm not very smart, but I really struggle with remembering which means what in that situation and what's buying what. The thing is, we're interested in not can you figure out what quoting foreign currencies is, we're interested in the accounting behind it. So we're going to set it up so you can actually figure out what the exchange rates are. Now, if you do get it wrong, you won't get the entire answer wrong. You'll lose a few marks, and it's annoying, but you won't get 0 for it, because that would be a bit unfair. So first thing, make sure you get the rates around the wrong way. Now with sales, this is the average rate, because sales are assuming, unless you're told something different, happen fairly evenly across the year. Purchases generally would happen evenly across the year. Administration expense would happen fairly evenly. Depreciation, even though the entry might happen at the end, depreciation reflects the use over time, so it would happen fairly evenly. Income tax, to the extent they're paying it, happens fairly evenly. So we've got a few things in there. Opening inventory, it makes sense to use the opening amount. It seems fairly reasonable to do so. Closing inventory, the information you had about the ending inventory would be used here. And retained earnings open, it looks like you would use the opening as well. So it is literally just going, okay, for the line items which are not subtotals. So that's an important thing, just like in ABC where you don't put in entries on the subtotals, you use these to add up. We're only doing things where you'd actually have particular line items. These two are subtotals, so you don't put anything here, and these are actually using subtotals from what's coming above. This is a subtotal. So you're just using the things happening above. This is a subtotal, and this is a subtotal. So same deal. So that 361 that you have at the end there, that's not just taking the 335 and timesing it by the closing rate. It's based on all the things that have happened before that, and then just coming up with the net sum of all of those. Okay, the important thing here is keep that 361 stored for the moment. Okay, in a question that you get, you would not see this given up front. So you wouldn't actually have that shown. So you wouldn't even see a 0 there. It just wouldn't exist. Again, you'd see what's on this side. Assets, liabilities, just use the closing rate. That's, if anyone gets that wrong, it's like, really? I mean, that should just be fixed in mind. Throw it all in. Make sure you do the right multiplication or division, whatever you need to do. You end up with 2744 for assets and 1745 for liabilities, which means the net assets based on this amount, 2744 minus 1745, is 999. What we're left then is translating the two equity accounts, share capital and retained earnings. Share capital of 579, you can use pretty much whatever you want for the rate to translate it at, because equity is not given something to do it at. So in this case, opening a rate seems like a reasonable suggestion, but if you wanted to use something different, feel free, but opening seems like the most reasonable way to do it. Retained earnings, we don't translate it from here. It's probably, again, a more meaningful thing to just take it down from whatever you had in retained earnings from the profit and loss statement. And if we add 565 and 361 together, so assets minus liabilities give you 999, but the equity accounts that we've got there when we've done them add up to 926. Those don't equal the same thing. And as accountants, we find that very difficult to deal with. That's something that we need to manage because we can't sleep at night. It's problematic. I don't like it when that happens. So we need to make it balance. And to make it balance, you just literally figure out whatever number that you need to put in. And in this case, it's 73. That 73 is the FCTR, and that's it. That's all that you need to do. And we can dust off our hands, be happy that we have a nice balancing translated set of financial statements, and yes. Depends on which current, like it.
Which one's stronger?
No, you just have to look at what you're trying, like what you've been quoted and how it's been quoted. So I mean, I think in a few of the things I've done, I've quoted as just like 1 US equals something Aussie, but then I think in the New Zealand one, I had something Aussie equals something New Zealand. So it just depends on what seems the way it should be. So I think in this one, we were quoting one US dollar equals a certain amount of Australian dollars. So if it's, the FX rate there is, so that FX rate is what 1 US dollar is worth. And so you'd be multiplying it. So you've got 1 US dollar equals that amount of Australians. So 1 equals 1.09. So 912 would equal more than that. The 997.
Yeah, that makes sense.
Yeah, we wouldn't put, yeah, absolutely.
What if the sum of share capital and retained earnings is greater than?
Yep. All right. So what happens, so the question was, what happens if, let's just say for argument's sake, we ended up with, we end up with 1026. So if we had share capital and retained earnings equals 1026, not 926, what do you think you'd do? Yeah, it would be negative. So you can have negative retained earnings. You just have a negative number, and what do we need to make that work? Negative 27. So you just have negative 27. So yeah, you can quite happily go that way. Awesome. All right. That's all she wrote. So identify why accounting for changes in foreign currency exchange rates is problematic, and that's because they change. If they're all pegged to something and didn't move at all, we just literally have to get out a calculator, punch in what the multiplication rate is or the division rate. That's all that you'd have to do. The fact that they do change makes it a little bit more problematic. We looked at the regulation around it, and we looked at transactions and translations. With transactions, we looked at monetary and non-monetary. With translations, the two things to remember are the rate depends on the account type and the FCTR. So remember those two things, everything else sort of falls into place. That's it. If I don't have you for the tutorial tonight, and if I don't see you on Monday, good luck for Tuesday. Have a good weekend. Hope the study goes well. Remember, the discussion board will be up and active if you have questions, and good luck. Enjoy the holidays, and I'll see you back in a couple of weeks.